Welcome to a fundamentals overview of Accenture plc, built directly from data filed with the SEC. Right now, the stock trades at a price-to-earnings ratio of about 65 times, a number that sets the tone for everything we'll unpack today. Here's the headline picture. Accenture is currently priced at $146.99 a share, with a market capitalization of $91.3 billion. Its price-to-earnings ratio sits at 65.33, and book value comes in at $51.33 per share. Return on equity is 4.43%, and return on assets is 2.05%. Let's dig into what each of these actually means. Comparing the current price-to-book value gives us a price-to-book ratio of roughly 2.9 times. Combined with that 65 times PE, this is a premium valuation, well above the broad market's typical high teens to low 20s range. That premium tells us the market has already priced in expectations for future growth, which raises the bar for what the company needs to deliver going forward. Turning to profitability, operating margin stands at 11.65%, while net margin comes in at 8.04%. That roughly 3.5-point gap reflects interest, taxes, and other costs below the operating line. Gross margin isn't broken out in this dataset, which is common for services-based businesses. Return on equity at 4.43% runs higher than return on assets at 2.05%. That gap normally comes from leverage, but with a debt-to-equity ratio of just 0.16, the leverage effect here is small. Most of that spread still comes down to underlying profitability, not financial engineering. The balance sheet tells a conservative story. Total assets are $68.8 billion, with cash and equivalents making up about 15% of that. Long-term debt sits at $5.03 billion, well below the cash balance, leaving a net cash position of roughly $5.1 billion. Combined with that low debt-to-equity ratio, this points to a company with a lot of financial flexibility. On the income statement, revenue for the latest reported period was $17.6 billion, with net income of $1.4 billion. That works out to diluted earnings per share of $2.25, and it lines up exactly with the 8% net margin we saw earlier. Putting it together, the strengths are low leverage, a solid net cash position, and healthy margins. The watch points are a rich valuation that's pricing in real growth, modest returns on equity and assets, and the fact that gross margin isn't disclosed here. This is a snapshot, not a full trend line, so treat it as a starting point for deeper questions. 5 takeaways to carry forward. 1. Valuation reflects expectations, not just current earnings. 2. The balance sheet is conservatively financed. 3. Margins are solid, but capital efficiency is worth tracking over time. 4. A single snapshot isn't a trend. Always compare across periods and peers. And 5. Verify everything against the primary source before acting on it. Every number in this deck traces back to SEC Edgar, filed under CIK 000-146-7373. This overview is for informational purposes only. It isn't investment advice, so please confirm any figures that matter to you against Accenture's original filings at sec.gov. Thanks for your time.